All right, folks, my name is Roger Scott, and I'd like to welcome you to our midweek roundtable. I have our guest, Jeff Zananeri, here. Jeff, how are you today?
I'm great. How you doing, Roger?
I'm doing really, really well. Thank you for being here with us. And what is on the horizon this week? What are you looking at? What's the biggest concerns you have for the market? Let's get into it.
I mean, it's still the same game, isn't it? We've been talking about it for a while, this growth versus value, and people are like capitulating on themselves today. I don't know if you've had a chance to look at some of these high flyers, but they're flying even higher. Salesforce is getting added to the Dow Jones. It's up 28% today, and leading up all the rest of the software stocks are all flying. Stay-at-home stocks are doing very well. Um, the value stocks are not doing very well. Russell 2000's down today. NASDAQ's up 1% today. Airlines are down. Oil drillers are down. Um, a lot, it's the same. It's the same thing. People want this seamless transition, and it never works that way. And I know why people do,
No.
because we have to fight it ourselves, right? The hardest thing for a trader or an investor to reconcile is that, you can miss a trade from time to time. And then you have to get right with the market. It's not about what you want to see happen in the market to prove yourself right. It's about, what is this market doing? Why is it doing what it's doing? And what would change that? And if you can't answer those things honestly, then you don't really have a thesis for things to change.
Right, right. It's very true. Very good point, and very, very powerful point. Um, I was looking at some sentiment indicators this morning, and I'm starting to see things I'm not very happy about. For example, the put to call ratio. The put to call
Yeah,
ratio hit 0.65 this morning.
right.
That's telling us that the level of exuberance in the market's a little high. Now, as you know, it doesn't mean we're going to have a major crash. It just means that that rubber band is just a little bit stretched out.
Yeah,
I'm also seeing industrial sector and consumer staples begin to take over industries such as healthcare
yeah.
and other industries, and that's also very defensive. And we're also continuously seeing precious metals continue moving higher, and material stocks moving higher. So, but
Mm.
that has a lot to do with other factors such as the overall economy. But the fact that consumer staples and industrial stocks are moving, and the fact that in addition to the put to call ratio, I'm also seeing really strong divergence now between the RSI and the Nasdaq 100, and the RSI and the S&P 500. But here's one indicator that's very, very interesting. I don't know how you feel about this. I'm going to put a little wrinkle into our analysis. There is a over-the-counter stock exchange in South Korea. All right. Here
Yeah,
we call it Nasdaq. There we call it Kosdaq. I'm sure you've heard of it.
yeah. Of
Well,
course, yeah. I love Asian indexes.
well,
Great.
you'll probably agree with me that the correlation between that and the Nasdaq, if you put them next to each other, the correlation between them has been literally uncanny, uncanny. That's the South Korean technology, and we have, the Nasdaq. And if you look at them, they're very, very correlated. I've looked at them over,
Yeah.
and I look at them about once a month, every couple of weeks. The last 2 weeks, 2.5 weeks, the Kosdaq has been going straight down, while
Yeah.
while the Nasdaq 100 has been propelling higher. So I wanted to kind of get your opinion, and I know we're kind of moving from the broader perspective to more of a micro perspective, but I wanted to get your opinion on that, because these are pretty prevalent things, and I wanted to get your take on all of it.
Yeah, so there's a flight to American tech and Chinese actually too. A lot of the Chinese techs have been flying too. And I've been surprised by that. I expected a flight to the US tech, but it's really been US tech, Chinese tech absorbing all of the world's risk capital, so to speak. So as you know, and I don't know if people out there really understand this, like investment dollars are earmarked based on their risk adjusted return profile. So
Right.
you can have two things seem to be uncorrelated, but they're very correlated based on the fact that the dollars that chase them are the same dollars.
Absolutely.
They have the same risk return profile. And so we're seeing a flight to what I just said, that the US mega caps from all over the world, because that risk reward ratio is not as good. There's more risk and less reward. Now, we are overheating in the interim. And that's why you have to be a trader and understand these things. You can have a trend continue for a long time and then have a pullback because it just gets too crazy. That's why you have to have a tactical edge like you and I do with our systems to time into these trades. Because if you time in badly, you're going to be out a lot of money right away. And that's hard to do. It's hard to come back from a hole like that. So you have to understand what's driving asset prices higher or lower. And then you have to have a tactical system to implement it, I think. But I'm always going not back and forth with you. We're on exactly the same page, and we've been spot on right.
Spot on.
Is that you can't fight this tech train. You might not like this tech train. You might not want to get on it, but don't fight it. Don't understand why it's happening. Understand there's a premium being paid for companies that are making all-time record profits in the era of COVID.
Yeah.
It is what it is.
Let me ask you this question. How do you, if we do pull back a little bit, do you think that'll have any dynamic? And this is not a trick question, but a multi-layered question. How do you think it'll impact the small cap stocks? Do you think the Russell 2000 is going to be on the sidelines till the economy picks up as a whole? Do you think the trade war is going to be the major catalyst? What do you give me? I want to get inside your head with the small caps in light of what we're talking about right now.
So if I'm looking at playing the catch-up trade a little bit, it's with small caps because I think that you have a lot of room for small caps to do well. I'm more scared of large cap value than I am of small caps, if that makes any sense.
I wanted to hear you say that. That's exactly what I was hoping you would say. Yeah. I didn't want to put words in your mouth. I didn't want to put you in a corner, but that's exactly right. That's exactly what I'm saying. I get excited when people agree with me without you knowing what I'm thinking. This is great. Well, it's good that we're on the same page, right?
I'm bullish. Yeah, we are. I'm bullish on small caps. I'm bullish on financials, though they're not acting good. And I'll tell you what that's making me a little bit nervous is we're having this tick up in rates. And I think we're going to see today, everybody's waiting on this speech from Powell to get further guidance on how much inflation they're going to let it run to see what rates are going to do. But I wanted to see banks act a little bit better with this rate pop. But I think that your big risks in stocks over the long run are in companies and industries that are having secular shifts. What do I mean by secular shifts? They're not cycles. It's not a cycle. They're not in a down cycle. They are in a shift away from the way business is done. Secular shift. Like what's an example of a secular shift?
More of a disruptive, more of like a
disruptive industry. I don't want to be invested in things that are disruptive. I don't want to be the guy holding a taxi medallion, after Uber came out. Remember those things were trading for $1 million, Roger. You can't give those bad boys away now in New York City. You can't give them away. So you want to understand where your risk is. And there are still a lot of large cap stocks and sectors that have a lot of risk because they're in the midst of being disrupted and a secular shift away from their business. So broadly speaking, I think that you could have a nice real pop in small caps.
I do as well.
Especially when we get a real solid announcement about the vaccine and people going back to normal.
I do as well. I think if you look at it historically, the last couple of years, the biggest lagger has been the small caps ever since Trump and trade war, just because they don't have the capitalization. They're a one trick pony for the most part.
And they're limited. Limited.
I was about to say, and they're limited. And you said, and they're limited. That's exactly what they're limited. If you take a big boy, this goes, folks, I'm going to share a story with you right now, and you're not going to gain anything from this, but our readers will. Folks, it's very important to do this because when your knowledge is too dangerous for your own good. So always think in terms of market capitalization. In other words, if you see a large company like Apple coming out with something and you think it's the best thing since sliced bread, consider how much of an impact that'll have on Apple, because Apple is already so bloated and they have so many different things that they're doing.
Yeah.
Whereas if you think of a small company and that is their company pretty much, that can have a major impact. And I always give the story. The story that I give, Jeff, is in the 90s when Hughes Communication came out with DirecTV.
Right.
I went to the store. I saw DirecTV. I was like, this is when we didn't have satellites.
I remember, yeah.
When satellites were like this big,
Yeah.
And I was like, oh my God, this is going to kill it. I mean, this is the future, right? I got so excited about it. And I'm like, I got to get into this. I got to get into this industry.
Right.
And I got so excited. And then I did some digging and I realized that the owners, Hughes Communication and Hughes Loaded Company, that this thing has to have such a major impact.
Yeah.
It got washed into the market cap.
Not moving the needle, right?
Right. It just didn't move because okay, let's say this company makes $1 billion. Well, this is $100 billion company.
Yeah.
I mean, it's not
It's not impactful.
It just didn't. Yeah, it wasn't impactful. Whereas if it was a tiny company that came out with that discovery, well, it could have been the biggest thing since sliced bread.
Right.
So I always tell people, when you're looking at what a company does, always look at the market capitalization in light of what it comes out and what impact that product or service will have on the company. Because that, it has a lot to do with it, which is one of the biggest reasons why the Russell 2000 stocks have been sidelined, because most of those stocks are not big enough to say, okay, well, if we're not going to make money doing this, we can still make money doing this. If we're not going to make money doing this, we're going to make money doing it. They can't. They're a one-trick pony. You basically took both of their hands and tied it behind your back. So, and I know
a lot of them are just much more tied to the real economy, right? Like
exactly.
They're tied to the real economy. They're not going to get a premium for name brand recognition because they're not name brands. If they were name brands, they'd be large caps. They're not going to get a premium there's a big liquidity premium being paid too right now, Roger, because what happened, if you study macro the way we know macro, and by macro I mean the whole world and the big picture of investing and asset management, it used to be that, these buckets of money would be segregated because, you have your yield chasing bucket, which is like, okay, I'm going to buy bonds, I'm going to buy govies, I'm going to buy corporate bonds, I'll get 6%, 7%, 8%, 9%. And I'm cool with that because we're talking about hundreds of billions of dollars and you get really nice return on that kind of size of money. Everybody stays happy, the lights stay on. Well, now you don't have a big bucket of liquid bonds yielding anything significant. So you have that money being splashed across the equities universe, right? It's being splashed across the equities universe. And then it becomes a self-fulfilling prophecy. Should Amazon be a $1.5 trillion company? Well, who should have $1.5 trillion if not Amazon? Money fights money.
Of course.
Right? It's a zero-sum game. So like the argument that they shouldn't have it based on their earnings isn't how it should be graded. It's graded like on a classroom curve. That student deserves an A because everyone else in the class sucks.
Right. That's which is crazy.
That's life though. That's life,
of course. Of course.
That's life.
It is. But I agree with you. I think that we are overdue for a pop in the small caps. Also keep in mind.
I'm wrong.
Well, also the fact, I think there's a lot of I think it's politically driven as well, because think about Democrats and small caps versus trade war, Trump and his trade war.
Yeah.
Because remember, and folks, for those of you who are thinking, well, you're siding with the Democrats. No, because Democrats is very bad for large cap techs too, because they want to break those companies up.
Yeah.
So the doors here, you have trade war. Here you have breaking up large techs. We're talking small caps. I already thought about the large cap argument. That doesn't help. That doesn't help if Democrats win either, because they're going to try to break companies like Amazon up.
Well, the idea is this, right? The idea is that the prosperity that's being experienced in the large caps is going to translate into prosperity for the entire economy because it doesn't exist in a silo. It doesn't exist.
It'll trickle down. Yes.
It's going to trickle down, but it's not only going to trickle down, it's going to create a more stable, robust economy because you don't have panic in these businesses. You don't have fire sales going on to raise capital, right? So, and then people go out, and then people are going to say, well, if these guys are doing good, and now the vaccine's starting, well, maybe mom and pop's going to do okay. And maybe you can see some of that. But where I'm nervous is in the businesses that are not going to, just because the vaccine turns on doesn't mean they're going to have business anymore. Does that make any sense?
Give me some examples of the type of businesses you're talking about.
I'm talking about like casinos. I'm nervous about like brick and mortar casinos. Like I'm very bearish on Las Vegas Sands and MGM and these types of places, because I think it's going to be many years before they experience the same type of traffic that they used to have. I'd much prefer, and I do this with my money links. I've had a money link trade in this before, to invest in an online bookmaker like a DraftKings or a Penn. I don't know if you follow these Penn National.
Oh yes. Oh,
these stocks have been great.
For months at a time.
They've been on fire because they offer gambling opportunities for people from their home. They're catering to the reality of it. So that's what I mean. The disruption, industries. What would you do with your money? If your best friend came up to you right now, Roger, and said, I'm getting a consortium with a few of our friends. I just want 100,000, you can get X return. I'm getting 100,000 for a certain amount of friends. I'm putting in a restaurant in the hottest part of Ponte Vedra or South Beach. Just give me 100 G's. Get the heck out of my face. I hate that business. I hated that business when things were okay. 10% margin, 9% margin. Now you're going to seat half the place, and you're going to seat half the place with 1/3 of the demand.
It's not pretty. It's not pretty.
Those businesses are going to, they're in for secular. That's a secular shift. It's a shift to the way people live life. Those are businesses you don't want to touch with a 10,000-foot pole. So what am I saying? I'm saying, think of stock when you think of trading, when you think of investing, definitely think of what would I do with this money if it wasn't like a big company? Would it be something I'm interested in? Number one. But when you're trading, you should also think this way. Am I shorting a company that I'm using every day? Like I've been talking to people that want to short Amazon. I'm like, dude, you use Amazon for everything. Your groceries, everything is coming through this company.
This is what we're seeing right now is making Amazon twice as powerful as it was a year ago. This is
the only thing that can stop that trend is the federal government, because organically, the way the game is being played, they're winning too much.
Yeah.
The only thing that's going to stop it is the referee is going to come in and say, guys, you've knocked them, you beat them too hard.
That's one of the stocks that I believe is going to have an issue if Democrats take power. I think they're going to try to break it up
big time. The big ones they're going to go after, like with the big, bullseye is going to be, obviously it's going to be a Facebook, it's going to be Google, and it's going to be Amazon probably also.
Yeah. And maybe Apple. I'm not sure, but maybe Apple as well. It's kind of hard, but depending on how much further they go into the into the personal business versus the tech business. But that's
Apple's vulnerable to the trade war. Apple's vulnerable because we know that if Trump wins, like we can assume that if Trump wins the election, that he no longer needs to be reelected, that he's going to ratchet up the trade war. He's going to shift down into fifth gear.
Oh, there's no stopping him. It's going to go into, it's exactly what I was saying this morning.
He's going to drop the hammer on that thing.
He's going to squeeze it for everything it has.
Yeah, because right now he's still in a certain degree like a hostage to the stock market. He's a bit of a hostage.
Right.
He's a hostage to public perception.
He has to dance around he has to be very cautious.
The farmers to vote for him. They got phase one of the deal because they got the Midwesterners were getting killed on soybeans and corn. The Chinese stopped buying it. So then he went back to the table, and now they're buying a ton of agriculture from the farmers. He gets the farmer vote. He's not going to care about that stuff if he wins. So you and I are going to become political junkies in the next 2 months. We're going to be
so too.
People might get sick of it, but what they have to understand is this is not about our political bias. This is about handicapping your investments and your trading and the market's reaction to what's happening in the political theater. To not know how to analyze that is a huge mistake because there's mega opportunities in trading that stuff.
That's right. There's mega pitfalls, but there's mega opportunities. Absolutely. I couldn't agree more. Jeff, before I let you go, can you give us, if you don't mind, can you give us your pair of an idea, a link? I call it a pair trade. You call it money link. Can you give us some money link that you see working, that you like,
I have one that's kicking butt today that I put on this week. It's a fresh one, and it's an ETF. It's an ETF trade.
Even better.
It's an ETF trade. Hold on, let me just pull it up here just for a second.
Sure. I'd love to hear it. I never put you on the spot about your current trades, but I figured, since the markets are a little vulnerable, it would be really good for our guys to kind of hear what you're doing right now, if you don't mind.
Yeah, I don't mind at all. So I have a position where, and this is going to be, I trade ETFs on a swing basis. So by swing, I mean, I hold it for a week, maybe 2 weeks. And I use ETFs because I don't want a news bomb to drop on me.
Sure.
I'm going long short. And I know this is a bull market. And then it makes it tricky because I know this is it, but I don't know what the future is going to be. So I have a short. That's just the system, right?
Sure.
I'm long. Check this out. I'm long the S&P, the SPY, because it's lagged the NASDAQ. I have an IWM swing trade too, but the bearish part is the interesting part of this. So long S&P, short EWZ, which is Brazil.
Yes.
Brazil, so when you have an ETF position, if the currency gets weak, the ETF in the US goes down.
Yeah.
So today, the Brazilian real is getting real weak. So dollar BRL is going higher because Brazil has been one of the worst countries in the world in containing the COVID.
Yes.
Furthermore,
and their real estate market is very weak right now. Their whole economy is terrible right now.
They announced today that they have to stop a social program that people are relying on.
Really?
And it was a 2% move in the currency right away. And the stock market's okay. It's firm because the rest of the world is bid so hard. But if we get a little bit of bearishness, they're going to destroy Brazil. They're going to destroy the currency, and there's going to be hyperinflation in the currency, and the stock market's going to fall apart. And having puts in EWZ is going to pay you very nice. And I think it could happen in the next 2 weeks.
I'm actually looking at banks in Brazil right now to short. I was doing
those are the biggest part of the index, that and oil, Petrobras. So if you're bearish on emerging market currency, if you're bearish on oil drillers, and if you're bearish on emerging market banks, and you want it all diversified a little bit, EWZ is something to look at.
Perfect. I'm doing something very similar with Spain right now because we talked about this before. They're banking their real estate. It's just terrible right now.
They're having a second wave too. It just came off the tape.
Yes. And remember, folks, everything you're seeing with COVID-19 in the U.S., it's a lot worse in third world countries like Brazil for obvious reasons.
Well, here's the thing, man. They don't have, like the way bonds work, right? The big treasury bonds, you have an auction and everybody buys U.S. treasuries all over the world. But when the Brazilian government goes to sell Brazilian bonds, they're not as nicely attended as the United States. So
I could tell you horror stories about, Jeff, I know. Back in the day, I met one of my hedge fund partners when I was a broker, and he wanted to trade real futures. We would get those guys on the phone, and they would be, "We're at lunch right now. We'll be back in 5 hours to play." It would take 5 hours to get a bid in the offer. Okay.
I know this stuff.
True story.
I know these stories. I've lived these stories. So I look for these opportunities. It's not like mainstream. That's the beauty of, I think, what I really enjoy talking with you, Roger, is we talk fundamentals, we talk domestic, we talk sectors, but we also have a global perspective. And sometimes if you need a short case, which I do because I'm always trading pairs, I have to get outside of the U.S. because I don't like a lot of shorts in this country right now because I see squeeze potential everywhere.
I agree with you. Well, listen, Jeff, let's leave it here. This was a great session. Again, the goal of this, folks, is for you to get inside our heads and start understanding how we think, our thinking process. And Jeff, thank you for giving us that pair trade, the link trade.
No problem.
Appreciate it. Thank you.
If you want them fresh, they work better fresh.
Absolutely.
Look at Money Links and sign up.
Please, absolutely. Check out Joy of the Trade. Go to Money Links and save up. And folks, and if you have a question for Jeff, please don't hesitate to contact him. Jeff@joyofthetrade.com. Give us feedback. Send us love letters. Let us know if you're enjoying this. Give us some feedback. Good, bad, we'll take anything from you. If you want to reach out to me, you can reach me at support@marketgeeks.com. And again, Jeff@joyofthetrade.com. Thank you very much, Jeff, for being here with us. And I will see you next week, and probably I'll talk to you substantially sooner than that. Have a great day. Thank you for being here with us.
Thanks, Roger. Take care.